Welcome to the Pro Ticker Deep Dive. All right, so today we are diving deep into earnings season, but we're going way, way beneath the surface. I mean, our mission here is not to just analyze whether a company beat or missed its headline number.
No, that's often just managed noise.
Exactly. We are focusing entirely on the forward expectation curve.
And that's the critical pivot. The whole idea we're unpacking here is that the real investable signal is it's rarely that headline beat or miss. What really matters is how the results, and just as importantly, the commentary, how it all resets expectations for the next, say, 2 to 6 quarters.
So if you want to know what's going to drive a stock's price for the long haul, you have to track that reset.
That's the game.
And we're talking about what practitioners call the earnings revision cycle, or ERC. This whole concept is like a practical lens. It combines the hard numbers, the momentum of analyst estimates, with the more subtle language in the guidance.
And by the end of this, you'll know how to spot where the market's real expectation curve is going to land. Think of it as a shortcut to finding the durable signal, so you don't get fooled by those headlines that look great but hide a really weak outlook.
Okay, let's unpack that. If the consensus estimate is the number that flashes on every newswire, why are you saying it's such a weak signal? Why should we start by, almost ignoring the thing everyone else is focused on?
Well, because consensus isn't just a number, it's the outcome of a highly strategic process. Management often guides analysts toward a number they know they can beat. It's called managing expectations.
Right, setting a low bar so they can jump over it.
Precisely. They can time expenses, they can shift things around, all to engineer that optical beat. The bar they clear is rarely set at their actual true potential for the quarter.
So if that reported number is kind of manufactured, we need to break down what a surprise actually means. The research we looked at splits it into 3 practical layers.
That's a great way to think about it. The first layer is it's the accounting surprise. That's just reported EPS versus the consensus number. But like we just said, that can be managed.
So it might cause a quick pop or drop, but it won't last.
Exactly. Then layer 2 is the business surprise. This is the real underlying operational performance. Maybe they sold more units than expected or their margins were better. That's getting warmer, but it can still be a one-off thing.
Okay, so the third layer must be the one that really drives the stock long term.
That is the expectation surprise. This is the big one. It's the change in the earnings power for the next 2 to 6 quarters that's implied by the new guidance, the language on the call, and of course the analyst revisions that follow. The market doesn't pay for last quarter, it pays for the new forecast.
That completely reframes it. So we have to stop thinking of the analyst estimate as just one number. We should be treating it more like a term structure, like you see with interest rates.
Yeah.
A curve stretching out into the future.
The term structure view is vital. The market really cares about the full fiscal year, we call it FY1, and the slope getting there from the next quarter, Q+1. And then, what's the implied path into FY2? Big, durable stock moves almost always happen when those medium-term horizons shift.
And that information, the stuff that resets the curve, it doesn't all arrive at the same time. There's a timeline here. The numbers from the press release, they hit in minutes.
And that sets the immediate, often emotional knee-jerk reaction, but it's also the most managed piece of the puzzle. Then you get the guidance and language from the conference call. That's minutes to hours later.
And that starts to signal the slope of that curve.
Right, and the uncertainty around it. But the real commitment mechanism, the thing that drives the big money flows and the institutional screens, is the third piece.
The revisions.
That's it. The actual model updates from analysts, they take all this new information and bake it into their FY1 and FY2 numbers, and that trickles in over days, sometimes weeks. That lag, that's where the opportunity is.
Days to weeks. Okay, that delay you mentioned, it perfectly explains that phenomenon people talk about. Post-earnings announcement drift, PEAD, where a stock just keeps drifting up or down for weeks after the announcement.
PEAD is basically the market admitting, oops, we underreacted. And the takeaway for you is that the revisions, they're the measurable footprint of that underreaction. You can literally track it.
It's a readable footprint. I like that. But why? Why are analysts so slow to move their models? Why does this opportunity even exist?
It's mostly structural and a bit behavioral. First, analysts are naturally incremental. They'd rather make 5 small updates than one giant leap, even if the news is huge.
They don't want to be the one analyst way out on a limb.
Exactly. That's the second point, the herding pressure. If you're a big outlier, you get a lot of scrutiny. And third, and this is probably the most important, they often need explicit confirmation from management before they'll really change their long-term numbers, like for FY2. They wait for that narrative bridge.
So the best opportunities are around those inflections, when the first credible revisions start to hit and the whole herd starts to move. We need a toolkit to measure that. The research talks about 4 key metrics.
Yeah, let's break that down. First is revision breadth. This is all about alignment. It's the number of up revisions minus the down revisions divided by the total. It tells you if everyone is moving together.
So if you have 12 analysts and 10 of them move their numbers up, that's high breadth, high conviction.
You got it. Next is revision magnitude. That's just the size of the move. How far did the curve shift? What's the percent change in the consensus EPS for next year? A big magnitude move with high breadth, that's a major signal.
And then you look at the trend over time.
Yep, that's the revision slope. Is the trend accelerating or decelerating? If estimates have been falling for 6 months and then suddenly flatten out or turn positive, that's a huge potential inflection point.
Okay. And the last one, dispersion. This sounds like the opposite of conviction.
It is, in a way. Dispersion is just the standard deviation of all the different analyst forecasts. It's a proxy for uncertainty. And what's really fascinating is that when dispersion goes up, the stock's valuation multiple often goes down, even if the average forecast stays the same. The market just hates disagreement.
That brings us perfectly to the other side of the coin. The language, the soft information. Because dispersion goes up when analysts don't agree, and they don't agree when management sounds uncertain.
Exactly. Guidance isn't just a number, it's a whole package. It reveals management's view on demand, on costs, on risk. We can break it down. First, you have your quantitative guidance. The explicit ranges, that's what drives the fastest revisions for the next quarter.
That's the easy stuff to plug into a model.
Right. Then you have the fuzzier stuff, the qualitative or framework guidance. Directional comments, long-term targets. That tends to influence the longer-term forecasts, like FY2.
And the one that really spikes that dispersion metric we just talked about.
That would be negative guidance. That's when they're explicitly cautious, or even worse, when they completely pull their guidance for the year. That signals management has lost visibility, and that can really crush a stock's multiple.
Now, when we try to measure the tone of all this from the call transcripts, you can't just use a standard sentiment tool, right? Why is it so important to use those finance-specific dictionaries like Loughran and McDonald?
Oh, this is such a critical point. A huge rookie mistake. Generic sentiment tools see a word like liability, and they flag it as super negative. But in a financial report, it's a neutral, normal word.
Right. It's just an accounting term. It doesn't mean anything bad is happening.
Not at all. Or the word investment. A generic tool might see that as a negative because it's cash going out the door. But for a tech company, investment is a massive positive signal for future growth. You have to use the right dictionary or your signal is just garbage.
Okay, so assuming we're using the right tool, what language features really predict how the revisions are going to move?
We usually break it down into 4 components. First is tone, which is simple enough, net positive versus negative words. Then there's uncertainty. That's the amount of hedging language. Words like if, potentially, could. More uncertainty almost always leads to wider dispersion.
Hence specificity.
Specificity is absolutely key. Does management quantify things? Do they say margins will go up by 150 basis points because of X and Y? Or do they just say margins will be better? High specificity lets analysts plug numbers right into their models. It leads to faster, broader revisions.
And the last one sounds like a red flag.
It often is. It's asymmetry or defensiveness. This is when management spends way more time talking about all the potential downside risks than the opportunities. Or they sound really defensive. It's a strong predictor of negative revisions to come, even to the quarter they just reported looked good.
And this is where it gets really interesting, because the true aha moment is when you measure tone surprise.
Yes. It's not just the tone, it's the tone relative to the numbers. A company posts a huge beat, but the language on the call is super cautious and hedged. That divergence is a massive red flag. It's telling you something the numbers aren't.
That divergence idea brings us to the most powerful setups. Let's walk through those patterns from the research. First, the classic trap. Pattern 1, the beat but guide down, the hidden downgrade.
Right. The setup is so seductive. The headline EPS number beats expectations. The stock is up 3% in the pre-market. But then you listen to the call, and the language is just full of uncertainty. Wide guidance ranges, a lot of talk about macro risks, very low specificity on future costs.
So they pulled out all the stops to make the last quarter look good, but they know the future's getting cloudy.
That's it, exactly. Their forward visibility is getting worse, or maybe they know they have to ramp up spending. So even though the press release was green, the event is actually an expectations downgrade. Analysts hear that language and they immediately start cutting their estimates for next quarter, and then that flows through to the full year. Revision breadth goes negative and the multiple gets hit. That initial pop was a total head fake.
A very clear risk picture. Now let's flip. The hidden upgrade. Pattern 2, miss but guide up.
This is where the opportunity is. So the setup. The company misses on EPS. Maybe it's a one-time cost, something that's not recurring. But the key leading indicators, things like new customer bookings or backlog growth, are fantastic.
So the headline number is red, but the underlying business is actually accelerating.
Exactly. And the language on the call confirms it. Management is super specific. They give a clear reason for the miss. They quantify all the drivers of future growth. And the tone is just really constructive and confident.
So in that case, the market looks right past the historical miss.
Completely. Because the event fundamentally improves the forward curve. Analysts see that clarity and specificity, and they start raising their full year and FY2 estimates. The stock can actually rally hard on a miss because the new anchor for valuation is just plain higher. You get to buy the future while other people are panicking about the past.
So let's make this actionable. How do you build a workflow around this to capture that signal before everyone else does?
It has to be disciplined. We talk about time-based goals. Your 60-minute goal right after the print is to form a one-sentence forward thesis. You quickly look at the drivers, convert the guidance into a forward vector, and score the language. Is it uncertain? Is it specific?
That's the quick take. Then you have to validate it.
That's the 48-hour goal. You track the first analysts to revise. Are they the influential ones? And most importantly, you confirm what we call horizon propagation. Do the revisions actually flow through to FY1 and FY2, or are they just tweaking the next quarter? If the revisions are deep and the language was strong, your conviction goes way up.
And to wrap it all up.
To tie it all together, remember it's a composite view. Practitioners use what they call an ERC score, and you have to weight things properly. You might put, say, 60% on the revision momentum because that's analysts putting their necks on the line. Maybe 35% on the guidance language because that's the leading indicator, and then a little 5% quality overlay.
Which really emphasizes that the language gives you the early read, but you wait for the revised numbers to confirm the story. Now, to leave you with a final thought on risk management, the best signals, they have to have guardrails. You have to watch out for tone gaming. That's when a CEO sounds super optimistic even while the numbers are falling apart. And be careful of crowding. When everyone is on the same side of the boat, the reversal can be incredibly painful. Discipline, in the end, matters a whole lot more than just being clever. See you all in the next Pro Ticker Deep Dive.